TheoTRADE. This is Don Kaufman. It's February 2nd, 2024. We're just minutes after the cash close here on this Friday afternoon. Absolutely wild week in terms of trade. We've been higher, we've been lower, we've been significantly higher. Huge bifurcation inside of the marketplace. But really, what we're going to talk about almost first and foremost, not just some of the price action in the markets, but why bond selling may just break this marketplace. Let's get into it here on this TheoTRADE's weekend update. All right, let's start with the obvious. SPOOs finish up on this Friday, some 50 S&P handles. But just time out, stop right there. Let's go right to the SPX. And the reason I'm going to the SPX, well, if you're unfamiliar with this of course is expected move. And I'm starting with it because expected move is just absolutely unequivocally spot on. I mean, we hit the expected move, tagged it to the upside. So when you look at the week as a whole, you know, you're like, oh man, that week and the market was just going higher and it's doing this. Did a little dance, made a little love, get down tonight. I got it. But in the end, the market did precisely what it was supposed to do. So if you look at the week and you're like, it was a spellbinding week to the upside, really? Because the expected move for the week was $70.87. And it is shocking because what you're actually looking at right here is literally where the week started. Where did the week end? Right there. I mean, it's on. Yeah, you're talking about a $5,000 index product, right? Almost 5,000 is close enough. And we missed the line on the screen by less than what, 3 points? It's shockingly efficient in terms of the marketplace. So say what you will about, you know, the move is big and the move is this. The move is spot on to what it was supposed to be. Of course, more unexpected move towards the end of this video as, well, we start to handicap the expected move for next week. Expected move for next week is set in stone. Here we are. We're just after 15 minutes after the cash close. The expected move is good to go. In fact, we'll look at it right now. With a $68.72 is the expected move. People, again, we're going to go over that at the end of the video. All right, right down to business. A little like week in review. Look, on these videos, I like to be extraordinarily forward-looking, but you really do have to have a little bit of respect for what we saw this week in trade. For that, I'm going to go over here to the 30-day 1 hour, because one of the things I keep talking about in this marketplace, it's relevant, is the up and the down. We're getting two-sided trade, even though, okay, we're finishing the week higher. And I was mentioning this, you know, a lot lately. You know, oh yeah, we're higher at the end of the week. Oh yeah, we're higher at the end of the week. There's still incredible two-sided trade, especially for those of you that are like scalping on an intraday basis. But if you look at the week, I mean, this was a serious and precipitous slide following the Fed announcement, which I'll talk about in a moment. Fed fumble! Okay. Then, obviously, we get this just tremendous bid back to the marketplace. Well, largely predicated on earnings after the bell. A huge slip to the downside because of the jobs number, and then an explosive move based on what? Absolutely nothing but tech. All right, now, just wanted to get that out. That's my week in review. That is it. Let's get down to business here. Fed fumbles, but tech is everything. When I say the Fed fumbles, all right, got to realize the Fed comes out, and for the first time in a long time, the Fed actually sparked some sell-side activity. To break that down in the most simplistic terms, well, inflation maybe isn't necessarily dead, yada, yada, yada. The next meeting, okay, is not until March. And so much can happen between now and like March 20th. All I wanted to show you, though, is the probability now of no rate cut is now 80%. And I'm just going to say this because I think it's critically important. On the last few weeks, I've been talking extensively about this. In fact, on several videos, I even said, what are people smoking? They're not going to cut rates in March. But there is one aspect to that. So look, I got that part right. You know, you want predictability? That's predictability. I got that part right. What I am shocked about, and I think what people should be shocked about, if you had told me that just a few weeks ago that the March idea of a rate cut wasn't real, that now it's an 80% chance of not cutting rates. But if the March rate cut wasn't going to happen, you would have figured this marketplace would have absolutely cratered and tanked. So yeah, we got the part right. The other part though hasn't come to fruition. Look, I'm going to tell you exactly why. Tech, it is everything. Tech is everything. The market now has completely bifurcated. Obviously, last week's video, I was talking about just extreme and polarizing markets. That timing of discussion of that last week couldn't have been more, well, timely, because when I say that tech is everything and bifurcations are running the market, you know the best way to explain it? Forget about, let's pull up Tesla. It's down year to date. Like, look, I can show you stocks till I'm blue in the face. And NVIDIA, okay? There you go, up 37%. It's insane, right? That's not the way to show it. The way to show it, look at this. Bifurcation. Let me ask you something. When was the last time you saw the S&Ps up 50 handles? The advanced decline line in the S&P 100, slightly negative, okay? Most of the day, though, most of the day, there was actually 70 stocks trading to the downside. You want to know why 70 stocks are trading to the downside? Because everybody should have fear of the bonds. That's why bond selling might just snap this marketplace in two. It's just if the bonds are going to continue to sell off. And I'm going to come back to that here in just a moment because it is what is mission critical for this marketplace. I don't care what you want to think about. Nothing will ever stop NVIDIA. Really? The bond market will. It surely will. Okay? Because nothing matters when the bonds are tanking. Those rates start flying high and everybody's going to feel that pain. Nevertheless, tech, okay, has actually become the marketplace at this point. And you got to bring up stuff like NVIDIA and forget about the year-to-date percentages. But when you have, okay, wait for it. We're going to come over here. We're actually going to look a $1.6 trillion company trading 5% to the upside. Yeah, that'll do it for you. $1.6 trillion of market cap getting pushed up. Well, it wasn't $1.6 trillion this morning. It's Meta. Okay, Meta is now a $1.2 trillion company. They cracked the trillion mark and just kept on going for it, up 20%. Okay, there's your marketplace. Amazon up to the tune of almost 8%, closing in very close to $2 trillion, $1.7 trillion. Okay, and obviously Microsoft up well over now, $3 trillion. Meanwhile, Apple falling mildly, but Microsoft obviously now is king. Microsoft. But the interesting aspect of this is not just market caps and so forth, the bifurcation's even coming within tech. You know, I was talking about this last week too, and you know, it was the Magnificent Seven. I'm sorry, Tesla is no longer magnificent, okay? It's spectacular. No, Tesla's actually kind of fallen by the wayside a little bit. But let me just ask a question here. Anything else actually moving markets? And the answer is unequivocally, no. There's nothing else. Well, you want to talk about energy? Here's the energy sector today. Massively unchanged. ExxonMobil and so forth had earnings today, massively unchanged. The financials, you know, interestingly enough, the financials opened a little higher and then faded into the close, but for the most part, up, 0.4%. And I have to tell you, I'm pretty shocked about the financials because overall in the week, let's go into auto expected moves. Or overall in the week, they didn't exactly get it done like the S&Ps did. The S&Ps unequivocally are driven at this point in time exclusively by a handful of tech stocks. And it's not even all the tech stocks. You have Microsoft, you have Amazon, okay? You have Meta. You can't include Google in that pack, right? Because what happened to Google, okay? Flat on its face. There are no longer 7 like tech titans in play. As I said, Tesla actually dropped out. Apple looks like crap this week. I mean, look, it really does look like crap. If you look at the expected move, it didn't even catch the lower edge of the expected move, even after the rally back and the fade in here. Nevertheless, you got problems. You literally have Microsoft, you have Amazon, okay, Meta, and NVIDIA running the marketplace. It's it. That's what you have. That unto itself makes this marketplace incredibly dangerous. It is. It's inherently dangerous. And it's, look, I'm not here to scare you. Be a bear. Look, I have bearish positions on. You know what happens to people that have bearish positions on when the S&Ps are up 50? You get run over. I'm thankful, though, some of the biggest bearish positions I have, okay, are actually in the financials, carrying a lot of positions in like XLF, right? So I'm actually short like 1,200 shares of XLF. Ooh, it's still leaving a mark. There's no question. XLF is up. It's leaving a mark. I'm also short some shares of like JP Morgan in there, a couple short shares inside of Wells Fargo, on a partridge in a pear tree. And that's the only saving grace for somebody like me in a trading session like today, is that some of the stuff that I was short, I didn't get completely run over. I'm short a little bit in the S&Ps though, and that is going to leave a mark. Nevertheless, let's get down to business here. Really, the entire video here is when bond selling, it just might break the markets. It is totally and completely, though, predicated on the idea that this bond selling actually continues. So when the bonds sell off, all right, for those of you that are maybe, what are you new? Bonds sell off a little bit. This is now the TNX. This is the interest rate associated with the 10-year. Yes, the bonds are the 30-year. I'm very well aware of that. But here, the 10-year actually, okay, it's been falling considerably. One day, pop, right north now of 4%. That's pretty critical level. From my point of view, if the bonds actually continue, okay, to sell off, right, this 10-year, it doesn't, look, one more big day, thing hits over like 4.2%, people start to freak. So you're right on the cusp of a really, really significant like panic, specifically inside of financials, but financials can tip everything, including tech. The one aspect though that really resonates with me, look at the volume in the last couple of days. Okay, this is, I use this phrase all the time, but this is really, it's like Panic at the Disco in here. The volume in the bonds denotes that this is some of the biggest movement that we've seen in recent history, period. Okay. I can't tell you. All right. Look, we're looking at MACD and a Fibonacci and a Bollinger Band. Okay. On Wednesday, when the marketplace was cratering down, markets were rushing into bonds. All of a sudden, the jobs number comes out. And when the jobs number came out, it basically said, the economy is much stronger than we anticipated. Bam, they slammed the bonds back down. Fed's not going to cut rates, okay, which creates even more of an issue. So money flows out of bonds, heads into the dollar in a huge way. The dollar exploded, okay? All of a sudden, the bonds on Wednesday were a defensive play, and they were. Like, as I said, as soon as the Fed gave a little bit more of a hawkish stance, people were rushing into the bonds. You're like, why are they rushing into the bonds? Duck and cover, because they think the marketplace is going to tank. And guess what? On Wednesday, the marketplace did tank. All of a sudden, the jobs report comes out, okay? It's incredibly strong. The jobs report was sick, 353,000 jobs. Okay, I don't care what you think of the jobs report. It doesn't matter, okay? It's 180,000 jobs expected. It hit, 353? Every server in the world turned around and started selling the bond market, okay? Meanwhile, they rotated very, very rapidly into dollar. Dollar to me, again, this now, okay, becomes, if you will, risk mitigation. So get into the dollar. Why? Dollar safe. Dollar safe, especially when, other portions of the world right now, look at China. Yeah, you want to be in the Chinese yuan in the middle of a crash, right? Chinese, again, Chinese markets are actually, falling by the wayside a little bit, but there's just not a lot of safe places in the world. So you start actually flowing into dollar, out of bonds into dollar. Meanwhile, out of bonds also turned around and apparently bought a couple of tech stocks, but that was about earnings. Tech was all about earnings. But again, that bifurcation just be felt. This is the bifurcation felt around the world because the market caps of these tech stocks now, okay, they're everything. As I said, tech is everything. The Fed fumbled, and tech actually picked up the ball and ran with it. And you got to think that way, not just because it's football season, but because tech really is everything. You can add up now all of the financials, okay, and almost all the energy stocks, and you realize that doesn't even equal 2 of the tech stocks. That's how significant they happen to be. So really, really critical. When I say why bond selling may actually break the markets, it's not going to take a lot more selling. But if the bonds continue to see some sell side activity, it will snap the back of the S&Ps. Bonds are just look, the S&Ps are not going to be able to take it. And I say that without hesitation or unequivocation. They're going to come even for big tech stocks. That's what you got to be careful of this next week. And as I said, just because I'm carrying bearish positions, I'm not trying to get you to bear up. Everything I try to think about is risk reward. And even though markets are like literally closing at all-time highs, S&Ps are going to hit 5,000. Okay, and that's a spectacular number. It's 5,000. The risk reward though is not going to be good. It's not going to be clean with those bonds actually selling off. It's a dangerous marketplace. You know, any piece of data can come out and absolutely rock this marketplace. There's some other issues here too. One of the things that really bothered me about this, you know, you see this spectacular, you know, rally. You realize that volatility throughout the course of the last 2 weeks is actually elevated. And on a percentage basis, that's decent. That's VIX, and I'm not a big proponent of VIX. Okay, I'll look at stuff like, you know, volatility, the volatility index, even the VVIX, it's considerably higher. There's a bit under volatility. Moreover, skew, okay, holy skew. If you look at skew, we are actually in record turf. By the way, that is skew right up there. We're in record turf actually for skew. So those coupled, like, look, it just simply means that even though markets are spurting to new highs, because the market is so wildly bifurcated right now, trade is still running for hedges. They absolutely. So you're looking at near one of the highest skew prints in the history of skew. Okay, volatility, and again, the VIX closed down a whole 3 cents, but volatility creeping up in the backdrop. Volatility going up at the marketplace going up is never a good thing. But what's going on in the marketplace, I was talking about this on Wednesday too. Every time you look at the market, it just seems to get like more of these tent poles getting knocked out from under it. There's just not like, how many bright spots are there? I mean, literally, like, look around. How many bright spots are there? And the answer is, look, even stuff that finished up today, like home builders, okay, it was basically flat. All right, look. Caterpillar's the big winner, but even stuff that was up today, it was minimally so, okay? And there are some big market caps that are still pulling this down. I mean, even stuff like Intel just getting clobbered day in and day out. And it's kind of just, you know, digging and undermining the overall S&Ps to the point where one of these tech stocks can start to break, right? You just don't have a lot, okay, to rely on. And that's one of the things that makes this marketplace, okay, so incredibly dangerous, and why bond selling, that might be, you know, the straw that breaks the camel's back. Now, okay, let's get back to the SPX, as I always call it, the mother of all products. So as I was saying earlier, the SPX, let's actually write this up. We're over here, okay? The SPX in this last week of trade, that's right here, okay, was plus or minus $70.87. What did we do? We tagged it spot on. So as I said, you know, earlier, you know, say what you will about markets. It was an astounding rally, okay? And you'll listen to the media. It was unprecedented. Yeah, unprecedented within 3 handles of hitting a line that we drew last Friday. Now, what makes it much more important, though, it's not what happened in the past, okay? Forget the past, man. Like, again, week in and week out, look at this. Last week, we missed the expected move, okay, by what? A couple of points. The week before, we hit the expected move almost to the penny, okay? It's ridiculous. It's uncanny how efficient things are this next week. The most important thing is this, okay? Look, what's the expected move for the next week of trade? Survey says plus or minus roughly 68.16. Now, I'm just going to throw this out here. This next week, you don't have a Fed announcement, right? Okay? You don't have the jobs report, and you definitely don't have, you know, Apple and Amazon, Meta, okay, and every other tech stock coming out with earnings almost the exact same time. So why is there a $68 expected move? Okay? I'm going to tell you exactly why. Because what you're actually seeing is markets rallying, but risk actually increasing. And again, you're going to look at the calendar Okay, and you're gonna be like, well, something's got to be coming next week. There is some data coming. There's no question that there's data coming. There's there's going to be some inflationary prints. Let's get crazy. There's some PMI construction. Look, it's nothing compared to the Fed. It's nothing compared to Apple and Amazon and Apple's earnings. It's just that everything pales in comparison. The market, what I'm getting at, it sees something. When you come off of a week with all of those events, and it's a 70-point expected move, with all the events, and we rally, and then the next week, why do we have a $68 expected move? And you go, that's the right question to ask. Because the answer is, okay, volatility is big. The market actually sees it. And moreover, okay, this is something we don't often look at. The volatility inside of the TLT, which is, of course, your bond ETF, 16.88%. You realize that the NASDAQ, okay, for a week has almost the identical volatility. So the next time you look at NASDAQ and think it's crazy out there, think again, because the bond market sees almost identical risk. In fact, the bond market sees slightly higher risk. Think about that, because that's exactly why I said, hey, look, bond selling, that may be what breaks this marketplace. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.